good evening. Thank you all for joining us here tonight. Tonight is a very special presentation I'm doing together with my friend and advisor in Australia, John Versace with Areté Wealth Partners. You can see a picture of John here in the upper right-hand corner. And we're going to be talking about the Aussie Expats Guide to Retiring. This is the Guide to Retiring in Australia. So the Returning Australian Expats Guide to Retiring in Australia. Of course, no presentation would be complete without going through some disclosures first and foremostly. So this does not represent personal financial tax or investment advice. And we would encourage you, if you're going to be making as important a decision as what we're talking about here tonight, to obtain professional counsel on those decisions, because your circumstances are going to be unique to you. John, do you have some comments to make about the Areté Wealth Partners disclosures?
Yeah, sure. So the fire warning has ended now, thankfully. It's perfect timing, but very similar to yourself, Ashley, that this is very general advice. It's not tailored to any particular individual. So do definitely get advice to your personal circumstances.
All right. Well, let's continue on and let's have some fun with this. So really quick, that's me with one of my better shots, I would have to say, an FPA conference a couple of years ago. Tri-citizen, moved to the US in 2005. I'm the founder and principal of Areté Wealth Strategists. We specialize in working with expats, Aussie expats in particular, in the US or departing the US, and Americans in Australia. We're not licensed in Australia. We work with firms such as John's firm, Areté Wealth Partners, for clients that are in Australia. And he's a licensed Australian Financial Services licensed advisor there and a CFP certificate. He'll tell you more about himself. There's a little bit about my background. This is who we work with. So as you heard me say a minute ago, Americans in Australia, Australians living in the US long term, and Aussies and Americans departing the US for Australia. And here's a little bit about John.
Yeah, excellent. So this isn't one of my better shots, but it doesn't get much better, unfortunately. So yeah, like Ashley mentioned, we're licensed in Australia. We don't have a license in the US, so we do team up with Ashley for US assets. So a little bit about the firm. We're a privately owned organisation in Australia, based in Melbourne and Sydney. We've got about 50 staff across the country and look after close to $2 billion on behalf of our clients. My particular specialty is around looking after US taxpayers. So whether it be US citizens living in Australia or Australians living in the US, and managing their wealth management and financial planning with their Australian assets. Yeah, that's
fantastic. All right, so here's the outline for tonight's presentation. I'm going to be talking about some issues to do with foreign exchange. Together, we'll have some comments about the Australian real estate market. John's going to be running us through superannuation, what we need to know there. I'm going to run you through US investment and retirement accounts and the results of a recent study that Morningstar did on that. Social Security, that will be mine. Age pension will be John, and John will wrap up this evening's presentation talking about the Australian side of estate planning. So with that, let's get into it. All right, so foreign exchange. What's been happening with foreign exchange lately? Well, that is a perennial question, that one. And here's what we have. So this is tracking the Aussie-US dollar relationship from the beginning of the year. And I note some interesting things. We commenced the year, much as we had for the previous 9 years, with a weakening of the Aussie dollar. This is a trend that's been going on, as I mentioned, since 2011. And then suddenly this thing happened. I'm sure no one's heard about it. No one's heard about it at all. Global pandemic, coronavirus. Yes, dad humor, so give me a break. So we saw it crash. John is very polite of you. It's pity laughter.
I'm sure everyone else is laughing as well. You just can't hear them. So
we saw the crash. We saw an intraday low there, hitting, almost 55 cents. An absolute crash before the CARES Act was extended and swap lines were extended to a range of countries and central banks around the world. Then we saw a progressive strengthening, getting back to what you'll later see me say is that, that natural rate, around 65 cents, which is where we were before coronavirus, 65, 66, before that hit. Then something else happened here in my hometown, a couple of miles away from where I am. The George Floyd incident went down, and there's been some civil unrest, which we've all heard about, of course, and that has really added to the speed and pace of this recovery. So we were really witnessing two things. We were seeing Australia getting ahead of the US in terms of its recovery from coronavirus, and then we saw civil unrest. And so that led to a real weakening of the US dollar and strengthening of the Aussie dollar with that pairwise combination. And just in the last couple trading days, we've seen a return back. In fact, you could almost plot that distance above 68,696 as being the cause of the civil unrest premium or discount, depending on where your perspective is. So my prognosis, or prognostication, as I look into my crystal ball, it's a little bit cloudy. My tea leaves are maybe a little scattered on the desk, but what I would see is that until about the end of the next earnings season, provided there isn't a massive blow up, unexpected blow up, I should say, and we're already seeing a recurrence presently, but I'm saying worse than that, until the end of July, I think we're going to continue seeing this strengthening. I don't have a particular price in mind as to where it's going to get to, but after we're through the next earnings season, I'm going to say that we're going to see the weakening trend continue. We're going to get back to that 65, 66 cent trend, and then see that continue to decline. And the reason for that, let me outline where I'm coming from in saying that, is the strategy for the economic recovery, the post-COVID-19 economic recovery, as outlined by Scott Morrison in late May at a National Press Club conference. He said, boils down to three pillars. We've got domestic tourism. Well, they're not bringing in export dollars as the tourists, the international tourists were. So that's got me a little concerned. International students, well, who knows what that's going to look like. A lot of question marks around that. The thought of staying in a hotel for 2 weeks has certainly scared off all but one of my clients from returning to Australia in the near future. And then mining. We see that Australia has been hit with some sanctions as a result of leading an inquiry into the genesis of COVID-19. China's none too pleased about that. So we hear that certain commodities are in demand as they've always been, but there are others. I think it was barley in particular that was hit with a pretty steep sanction from the Chinese. Also, going back to that tourism comment, it was just last week that I read in the Financial Times that the rumor mill has commenced in China, dissuading Chinese from travel to Australia. And that's a common geopolitical tactic that they employ. It was last deployed against the South Koreans a couple of years ago, and now we're having a little bit of tension. So that could certainly affect tourism flows coming from China. But we'll wait and see. You know, I'm sure this is something that will blow over. So another factor to consider is presently, as there was for many years, there was what's called a carry trade. And that was many clients would say, well, gosh, if I could keep my savings in Australia and earn 1 or 2 or more than that %, then why wouldn't I do that compared with keeping it in Australia? There was an interest rate differential. Well, now that's gone. We've got 2 countries both at 0. So that's eliminated that carry trade. And going back to the geoeconomic commentary from a moment ago, I'd say that Australia is really dependent on the economic prospects of 3 countries. 1, the US being its military ally. 2, of course, Australia itself, but we need to be mindful of just how big Australia's economy is in the grand scheme of things, less than 2% of world GDP. And 3, China. I hardly need to be the one to point it out right now, but Australia is in a very uncomfortable position being buttressed between 2 superpowers, having to choose between its trading partner, its #1 trading partner, and having to choose between its security partner. So that's those are my comments on foreign exchange. But when we come to be thinking of a major decision, moving serious money, moving your life savings from the US to Australia, this is something where even a small improvement can be worth thousands of dollars. And I just want to run you through 4 points that I assist clients with in making these transfers. So first is to understand the particular exchange rate that you're talking about. This is the history of the Aussie dollar floating since 1983 when it commenced its float. Excuse me. And you'll see that the average historical exchange rate is 76 cents. Doesn't mean a whole lot, as you heard me say. There's this 9-year trend ever since we hit 107 intraday back in 2011. We've been on this steady decline, but that is nevertheless the history of the rate. And the reason that that's useful to know is because that's going to give us some context to know when it's time to jump and to do something perhaps opportunistic. You know, when the rate hit 70 cents last week, I was quick to notify clients and say, now is, if you're moving US dollars to Australia, let's maybe think about putting a pause on that. And if you're moving Aussie dollars to the US, we might think about putting that foot on the accelerator to get that moving as quick as possible. One thing I never tire, a spreadsheet I never tire of showing is my foreign exchange forecast. Just need to get that out of the way. Foreign exchange forecast. And this really goes to show, the point of this slide very quickly is to show you the value of a small difference in improving your exchange rate. So right here, let's go to the second tab on the sheet. Let's say if you happen to have 1.5 million US dollars and you were moving back to Australia, currently using the formula you see here, 68.74, that's the exchange rate presently. The interbank rate, that's the rate at which the banks do foreign exchange with one another. Of course, foreign exchange providers, they're not doing it for love, they're doing it for a profit, and so they charge a markup. That markup is what we call the spread. And you can see here the spreads with a range of different providers. So Interactive Brokers is just one of the custodians that we use, and they've got the lowest spread in the business that I'm aware of. It's also the lowest anyone else I've ever met has ever heard of, 0.002. John, have you come across lower than that for Forex?
No, I haven't.
Next is AFEX, they're 0.2%. And that's a rate I've negotiated just for clients. But the best retail rate out there I've seen would be with OFX. AFEX's retail rate is also 0.6. John, have you seen better than 0.6 for a retail rate?
No, I haven't. And yeah, TransferWise and OFX, you know, without recommending any products here, tend to be the two most popular ones, and yeah, the two best I've seen.
So what we have, a lot of numbers on this spreadsheet, but what you see is that 1.5 million US at a pure interbank rate is worth 2.182 million Australian dollars. Now, there's going to be that spread. If you're doing your conversion with Interactive Brokers, they would take $436. That's what you'd lose to that spread. AFEX with a 0.2, you're losing 4,300. Just went up a second ago, wouldn't you know it? And then with the retail ones, you see right there, it's quite a spread. You know, you're talking about $9,000 to move to a retail foreign exchange provider. So right there, working with a professional advisor like John and myself, that's just one small way in which we can assist. But anyway, so getting the best foreign exchange rate and having a strategy for doing that is the point there. Using limit orders, I always ask clients, are you familiar with what a limit order is? Often they'll say no, and I'll explain, well, that's simply an order that you place where you'd say, I will trade X amount of the currency, but no lower than this level right here. And that protects that investor in the event of a unexpected currency fluctuation. So it's just a very simple strategy to protect and get a slightly better rate. Also, a clever idea is to think about a systematic conversion schedule. So what I'll commonly do with clients is set up, say, a quarterly conversion schedule over, say, a 2-year period. And that way we can get the best rate over that full period of time, over that 2 years. Now, that's not locked in stone. It's not as if on the first of the quarter, some algorithm triggers that we've got no control of, and it does some set amount. Of course, we're keeping our eye on that, mindful of what those historical trends are, and so we can be opportunistic when the need arises. Also, a more advanced strategy would be that of a costless collar, and that's a way of getting locked into a certain rate range. If you're or doing a forward is another derivative instrument you might consider that would help with hedging that foreign exchange risk. Moving on to the next topic here, John, tell us what the situation is with the primary residence exemption.
Yeah, so this has been a very topical issue, obviously, with expats and especially Aussies living over in the US. So, as many of you are aware, up until this year, you've been able to claim the 6-year tax exemption on your primary residence, where if you live out of your primary residence up to 6 years, you can still claim it as a tax-free asset for the purposes of the Australian taxes. Now, the legislation as of 1 July 2020 is that will disappear. There have been a lot of campaigns to extend that timeline or potentially look at amending that legislation. However, at this point, there's been no move from the Australian government, and we're getting very close to 30 June, so it does appear unlikely that there's going to be any change to that legislation. So what it means is that for a non-resident of Australia, selling your former primary residence will potentially mean that you will pay tax on the capital gain from when you actually purchase the property, regardless of how long you actually lived in the property. So it is a pretty harsh treatment. If you sell it as a non-resident, there are some strategies around that, but yeah, it's not looking great, unfortunately, if you are selling it overseas.
Yeah. What about this new home builder grant that's recently been announced? Can you make any comments about that?
Yeah, so it is a very new thing that has been announced by the Australian government, and that this is in response to COVID-19 and some of the stimulus packages that are being announced. So essentially, what is being it is means tested. There are some criteria that you need to meet. So basically, if your existing primary residence that you're making any improvements to, you can potentially make 150,000. Sorry, up to $150,000 worth of work. Or sorry, up to sorry, I'll just have a look. It is very new, but your property value needs to be $1.5 million or less, and the improvements need to be between 150 and 750,000 for any other property as your primary residence. If it's a new build, you need to have between 150,000 as the potential build. Your income needs to be as an individual, 125,000 as an individual or less. As a couple, less than 200,000.
Okay, so it's free money, but it sounds like there's a lot of strings attached.
A lot of conditions and a lot of things that you need to tick off before you look at taking advantage of this. Yeah. And the benefit is 25,000, I should say as well.
Mm-hmm. Okay.
As a grant.
So Australian property market commentary. Let's have just a quick chat about that. What do we see coming up? Well, first of all, let's run through the pros. These are the pros that I had identified. So strong population growth, although that's really on hold, as we all know right now. Lack of inventory, John. Do you see anything there? Lack of inventory.
Yeah, I do, and I think you know, there's a lot of challenges obviously out in the global economy at the moment, and I think those that have the ability to hold on to their property are likely to do so. We all know that there's going to be some challenges to potentially selling some properties, and you know, you would think that the properties out in the market will be from people that need to sell rather than, you know, want to sell. So that will potentially lead to a lack of inventory.
Okay, low rates. Well, we're seeing historically low rates, so that's great. Negative gearing hasn't gone away; it's still there, so that's buoying things. And then let me see here. So on the con side, low housing affordability. It's funny how markets can stay. Is it Milton Friedman who said that, or John Maynard Keynes? I forget it. Markets can stay irrational longer than you can stay solvent. Not a perfect, not a perfect saying for this one, but I remember one of the first webinars I did was talking about the Aussie real estate market, and the economists, that every couple of years they put together a global housing affordability index, and Australia was the second least affordable in the world after New Zealand, and it hasn't actually moved that much, which is remarkable. What's worthy of mentioning also from that forecast was they were saying this is going to act as a dampener on growth because prices simply can't go up forever and ever. It kind of reminds me of what happened in Japan in the late 1980s when affordability got so stretched that they had to move from a 30-year mortgage to a 100-year mortgage so that people could afford to buy. So low housing affordability, and really maybe that's inflammatory for me to use the word crackdown there on non-resident investors, but tell me what you think of the use of that word, a crackdown, with all the loss of capital gains exemptions, the stamp duty situation, ghost taxes, all sorts of things that hit non-resident investors. John?
Yeah, I think it's a good word for it, Ashley. It's yeah, there's probably no other word for it. It is certainly looking at you know, for whatever reason they have a crackdown on the non-resident investors by the Australian government, and the low housing affordability is a key point as well. So I guess in terms of property, you know, over the last 20 years, we've seen an enormous boom in Australia on property, as I'm sure everyone's aware. And there's been a lot of things that have fueled that, but a lot of those fuels are dying off. You know, we had the mining boom in Australia, which has been fantastic for the Australian economy. However, China, as you mentioned earlier, there are a few reasons why China and you know, a potential appetite for our resources are diminishing. Not to say they're going to disappear, but they, you know, it's certainly not going to be what they were in the you know, the 2010 or you know, those sort of periods. But then you had there was a massive amount of you know, the appetite for lending from certain banks, and there was a Royal Commission into Banking and Financial Services last year in Australia, and that has had a pretty big impact on how much banks are able or willing to lend. And you know, also Australia's had an enormous period of economic growth, the best in the world.
Yeah.
So it's been a world record of continuous growth in the Australian economy, which has helped fuel these you know, property prices. However, that can't continue forever. You know, we're not an immune economy. There's a certain point where wages will struggle and economic growth will struggle, which, you know, we're going into our first recession since 1991, I believe. So a lot of things that have fueled property prices are potentially not going to be there in the next 5 to 10 years, in my opinion.
Yeah. All right. I should mention also on that very topic, so next month's webinar is in fact on real estate for the expat investor. I began to do the slides for tonight's webinar, and I realized there's just so much to it. You know, it depends on your perspective. Are you a non-resident with Australian property, an Aussie resident with foreign property, or an Aussie resident with Aussie property? These are all different situations, and so I'll go into that in more detail next month. But superannuation, John, walk us through, what do folks retiring back to Australia need to know about superannuation?
Yeah, thanks, Ashley. So in terms of superannuation, I mean, we could run a full seminar on superannuation on its own. It is a pretty complex area in you know, in the Australian system. I'll give you, and especially when you throw US taxes into the mix as well, there is, you know, things can get quite messy. But I'll walk you through just some of the basics of superannuation. first thing I'll focus on is how you can get money into superannuation. So the first way most people get money into superannuation, as you've got on the screen there, is through concessional contributions, and that's using your pre-tax money. That's money that you have not paid Australian income tax on. So the limit on that is if you're 65 years of age or under, you can put $25,000 a year in. Now, this is including what any employer is mandated to put in as well through super guarantee in Australia. So you need to factor that in as well, but you can put that $25,000 in. For those aged between 65 and 75, you can also put $25,000 in, so long as you've worked 40 hours over a 30-day consecutive day period through the financial year. And again, that includes what your employer puts in. So that's the concessional contributions. Now, in terms of Australian tax, you will not pay Australian income tax on those contributions, but you're taxed at 15% on entry into the fund. So there can be some planning opportunities there on the Australian tax side of things for those types of contributions. Now, the second way you can get money into super is through what they call a non-concessional contribution. So this is using your after-tax dollars, so money that you've already paid income tax on in Australia. You can put up to $100,000 per annum if you're under the age of 65 into superannuation using this method. For those, actually, you can also put in $300,000 under the age of 65 using the next 2 financial years. So that is often a method that some people will use. So if you put that $300,000 in under the age of 65, you then can't put any more after-tax dollars into super for the next 2 financial years. Now, over the age of, so between age 65 and 75, again, if you've worked 40 hours over a 30-day period, 30 consecutive days during the financial year, you can put in $100,000 only into superannuation. And if you've reached the $1.6 million cap as of 30 June of the previous financial year, you can't put anything in of your after-tax dollars. So that's just one thing to bear in mind there with some recent changes to superannuation. Now, one thing to bear in mind is the potential US tax treatment of extra contributions into your super. You need to be very, very careful of it if you are in the US tax system. So super, as Ashley is going to touch on in a little bit of detail later on, superannuation for US taxes is a complex area, and it's not mentioned in the double tax agreement between Australia and the US. So you do need to be a little bit careful here, but putting in, as a general rule, putting in more than what your employer is mandated to put in can change the treatment of your superannuation fund and can convert it to what they call a foreign grant or trust. So just be a little bit careful there. So a foreign grant or trust means that you'll be taxed on the earnings within your super fund on your income tax every year, and it can complicate a few other issues within the investments within your super fund, but we'll go into that a bit later on. So when can you access your superannuation? So a couple of ways. So assuming you're a permanent resident of Australia, if you change your employer or leave employment from ages 60 to 65, you can access your superannuation. That is a condition of release of super. Also, after the age of 65, if you are still employed, 65 is a condition of release of superannuation as well. So that's another condition of release. And also, the other thing as well is with the current legislation on COVID-19 and some of the legislation that's been put in force by the Australian government, use the opportunity to take out $10,000 in the current financial year, 19-20 for Australian taxes, and also another $10,000 in the 2021 financial year in Australia. That's tax-free on the Australian government side of things. However, on the US side of things, release of superannuation, as Ashley will talk about in a second, can potentially be a US taxable event on your income tax return. So do just bear that in mind if you are looking at taking advantage of this provision. So this provision is available for financial hardship. There are a few conditions of that, but it mostly means if you were unemployed or you've left your job from 1 January 2020. So we do get asked a fair bit about SMSF and self-managed super fund. So just for those that aren't aware, self-managed super fund is essentially in Australia, you creating your own superannuation fund. You act as a trustee of your own fund. Some of the benefits of doing that is that you can purchase some assets that you cannot access through public offer funds or the more traditional funds that you've probably become accustomed to. So some of those assets might be residential property or commercial property that you could access through using your superannuation money. You do need to be aware of some of the compliance considerations of self-managed super fund, both in Australia and the US. So for the purposes of a self-managed super fund, there is a lot more that you need to do in terms of compliance. You need to maintain an investment strategy. You need to complete accounts for the self-managed super fund every year. There are a few things that you need to tick off as a trustee of a super fund. As a non-resident, there are a lot of things to be aware of and be very, very mindful of. There's a test called the Central Management and Control. So all the high-level decisions of the fund as a trustee of a self-managed super fund need to have been made from Australia and from Australian soil. So just be very, very mindful of that. And then the active member test. So people that are actually contributing to the fund are active members, and 50% of that needs to be from Australia or from Australian residents. The fund needs to have been established from Australia as well. So that's another thing as well. Failure to comply with those rules means that you could potentially change the tax treatment of your self-managed super fund from 15% to 45%. And in the first year that you are deemed a non-compliant fund, there is the actual potential that 45% of your fund can be taxed. So the actual 45% of the balance could go in tax. You need to be very, very careful with these rules. On the US tax side of things, just very quickly, just going to be very careful that, or just be mindful of the treatment. It can lead, or is likely to lead to treatment of your super fund, self-managed super fund, as a non-grant, foreign grant or trust. And again, that just means that the income is taxed on your personal tax return each year, and the earnings of the fund. And there's some extra reporting requirements as well. So just bear that in mind and get some advice before you do start a self-managed super fund and all the implications of it. The Australian tax treatment of superannuation. So after the age of 60, so if you release money from superannuation after the age of 60, it's completely tax-free. And also the earnings within superannuation. So as you're accumulating your super, the earnings within super are taxed at between 10 and 15%. If you start an account-based pension after the age of 60, there is nil tax on your account-based pension. Yeah, so I mean, it can be a very good tax environment on the Australian tax side of things. There are some considerations on the US tax side of things, which Ashley's going to go through now.
Yeah, and so John, thank you for that. As you were saying earlier, American tax residents are between the devil and the deep blue sea when it comes to superannuation. So you're either looking at an employee benefits trust and the tax treatment that gets, or a foreign grantor trust. I think perhaps the foreign grantor trust treatment is not as worrisome as it can be made out to be. It's certainly detrimental. It has higher tax implications, but we need to keep in mind that you're essentially paying the tax that will eventually be due at distribution. You're just paying it now. You're paying it probably in a higher marginal rate. So that's where it really becomes disadvantageous. But with an employee benefits trust, your basis in that, the taxable amount that is going to be much higher for each payment that you receive out of your super fund. So how do they determine which is which? Essentially, as John was saying, if you contribute less than 50% and you're deemed to not have control or much discretion over the investments within that fund, you've got yourself an employee benefits trust. If it falls foul of that, then you're looking at the foreign grantor. That's essentially what it boils down to, is contributions and control. In either case, the employer contributions is taxable income. So that 9.5% superannuation guarantee, that is going to be taxable by the IRS. And the last bullet is just what you heard me say a moment ago. We're very slowly putting together a white paper on that topic. So stay tuned to that. Speaking of white papers, this is the next topic to talk about here. US investment accounts. So we're thinking of moving from the US to Australia, what to do with those US investment accounts. So this will be up on my website. It's actually written, it's done. It's just literally a matter of getting it up on the website now. It's based on a study by Morningstar, the Chicago Global Independent Research House. And every 2 years, they look at about 20 different countries and they compare the managed fund investment environment. Now, it is important to state here, this is managed funds only. If you're working with a top firm like APT, for instance, often you're in direct stocks or ETFs. So many of these comments won't apply if you're in that specific kind of investment strategy. Looking at managed funds as they did in this study, this is what they found. The US came out overall on top. They looked at 4 different attributes. First of which was sales and customer experience. Australia is actually on top of that, courtesy of the Future of Financial Advice reforms and the Royal Commission John was talking about a moment ago. There's a fantastic environment for fiduciary advice, really putting clients' best interests first. The United States, sadly, is lagging behind in that area, but the US is a big and diverse place. And so there's actually a whole number of different kinds of financial advisors you'll encounter. There's the fee-only firm like myself. The only way we get paid is directly by clients, and we have, since 1940, been regulated to put clients' best interests first. I would think on the professionalization spectrum, these are your most professional kind of advisors. Fee and commission coming there in the middle, so as to say, sometimes they're working and getting paid on a commission, sometimes they're working and getting paid on a fee. What's the difference? Well, there's an incentive to sell a product, and are they necessarily being blind to their interests and not yours, and solely serving yours? And commission only is exactly what it suggests. So that was the first criteria. Fees and expenses. Australia and the US actually rank number 1, tied number 1. However, this is something worth discussing a little bit here. In the white paper, I include a hypothetical scenario, because while the US and Australia both receive that top grade, there's still some daylight between what those fund expenses actually are. And you can see, putting together a 60-40 portfolio, there's actually a 0.45% fee difference. And that adds up over time. So if we were to invest this hypothetical portfolio for a 25-year period, you'd see a $43,000 difference in fees just in that Australian managed fund environment. And that's not including transaction, platform, or advice fees. I should mention there's been a price war in the US, and transaction fees from many of the major firms have actually gone away altogether. They might come back, but right now they don't have them on US stocks or ETFs. Platform fees, rarely do you encounter that in the US. Sometimes you do, and advice fees are, you pay for the value of advice that you receive. Disclosure, US is on top there. Australia is above average. Regulation and tax are both ranked towards the bottom. That's not to say that the US and Australia are especially bad. I mean, that's what you would conclude from seeing that. It's more compared to countries like Hong Kong or Singapore, where there might be no tax at all. Having to pay a capital gains tax is less desirable. And of course, the exact treatment that you will get will be specific to your circumstances. I know that with Morningstar's study here, they assumed a couple earning $100,000 holding that 60-40 portfolio for 5 years was how they determined their tax take. Other considerations for Americans overseas would include these three right here. And this is important to be careful. So dual citizen Americans living in Australia will still be subject to this. Aussies that are in the US on a visa or green card holders that come back to Australia and relinquish that, provided they don't get hit by other problems, such as being deemed a covered expatriate by the Hart Act and being subject to as much as a 40% tax on their global estate above $2 million with a capital gains exemption, but nevertheless, that is something that can really bite to returning to more successful, wealthy Aussies returning that if they're dual citizens or if they've been green card holders for 8 or 15 years, then that is a test that they'll have to consider. So that's not here on the other considerations because that's even broader than just investment accounts. But PFIC considerations, this is a big problem. I'm pleased to see Dr. Karen Alpert is on the line again tonight. I'm a big supporter of her organization, fixthetreaty.org. And it would only be fair to Americans to get rid of that. So essentially, if you're an American abroad, you cannot invest in local managed funds, ETFs, listed investment companies, any of those things that are deemed to really derive the majority, 75% or more of their income from passive sources. Otherwise, you get taxed at the highest marginal rate for every year that you held that investment. So it's very punitive treatment. It does mean that you would be looking at an individual stock portfolio to get around that. Foreign exchange we already spoke about, and home bias. My point there on home bias is a pertinent one. Home bias, what is that? It's a behavioral bias. We all have behavioral biases. We're all human. Home bias is the tendency to invest in what is close and familiar to you. I was shocked to see at an FPA conference a couple of years ago, there were local Minnesota mutual funds that came out, and guess what they invest in? They invest in 3M, Best Buy, Hormel, the maker of such fine food products as Spam, United Health Insurance, Target, all of the companies that are here. Now, if you could invest in any company in the whole world, why would you invest, other than just patriotism and love of your state, why would you invest in one specific place? That's called home bias, and we all need to be mindful of that. But that's specifically relevant to returned Aussies, given that we're talking about a country with 1.7% of global GDP, and buffeted between these two superpowers, as you heard me say earlier. So very quickly, just going through the retirement plan contribution limits for 2020, we see 57,000 is the total. Now, this is going to cause a lot of confusion because the number that everyone's familiar with is the second row there, 19,500. Now, that's how much you can put away as an employee into a 401k plan or a 403b. But let's not get confused. The 401k or 403b itself can take up to $57,000. So if you happen to be the business owner who works in your business, then you can make both contributions. You can contribute up to $57,000 a year, with $19,500 being your employee contribution and the $37,500 being your profit sharing contribution. Folks over the age of 50 may also contribute an additional $6,500. For individual retirement accounts, these are not company-sponsored plans. 401ks are. They have to be sponsored by your company. It's a completely different system, unlike superannuation, which just exists, and companies will get in big trouble if they don't contribute to super. 401ks are completely optional, and whether your company offers one at all is entirely up to them. But this is what is built into the Internal Revenue Code, IRAs. So you may contribute up to $6,000 a year, provided you satisfy certain limits. You see here, the second row, a traditional deductible plan does come with some eligibility concerns, especially if your spouse is a participant in a 401k plan at work. One thing I'm often saying to Aussies or Americans that are saving for their retirement nest egg is, if you are reliant, if you're getting started in your 30s or 40s and you don't already have a significant balance behind you, maxing out your 401k or IRA is just the beginning. If you saw the annual limits with super compared to what you get with 401ks, it's much higher with superannuation, and it puts folks in a much better place for retirement. So in America, we really need to be thinking about additional retirement savings over and above that's available through 401ks and IRAs. You can find those details of what I just shared right there in our key financial data sheet that's available on my website under media. We've just updated that for the Australian, the new financial year that is soon to commence. So for Americans or Aussies in America thinking of departing, we really talk about 4 different tax asset classes to contribute to. So you heard me say just a moment ago that an IRA or a 401k is not enough, and that's absolutely right. We're thinking about these other tax buckets as well, and there are different kinds of investments to put into each of these buckets to get the best tax treatment that such an account type will afford. What we need to be mindful of is that some of these strategies that work for US citizens intending on staying, or US persons intending on staying in the US, don't travel so well. And what doesn't travel well? Roth IRAs in particular. And that's because they can be double taxed. Same with health savings accounts as well, although rarely do you see the balances of those get up to be nearly as high. So just quickly on Social Security, Social Security is not a means-tested retirement program. Warren Buffett happily sits back every month and collects his Social Security check. So it's regardless of income or net worth. If you have paid into the system 10 years of taxes, and I've got a link right here, which will take you to the Social Security Administration. If you paid in your taxes, then you're going to collect your benefit. Now, exactly what your benefit's going to be is another question, but I would encourage you to come here, log in. It seriously takes about 10 minutes, and you can look up your own record and see exactly what you're in store to receive. Will you receive that? Is it guaranteed? No. Is it funded for you specifically? No. I've used an analogy here which works well, and that is your superannuation account is like your own personal lake from where you can draw your water supply from for the rest of your life. In the US, however, you don't so much have your own personal lake. You've got this giant lake where everyone is drinking from the same lake. So are you guaranteed your share? Not really. You're just guaranteed to be able to get a straw and to draw, or a hose, and draw from that lake when the time comes. So typically for clients, we discount what they're presently showing by about 25%, just because we like happy surprises and not unhappy surprises. Social Security, if you are in the financial position and the health, you feel you have the life expectancy in your own health history and in your family's genetics to last beyond age 80, then you'd be well advised to wait until age 70, because you're getting an 8% kicker for every year that you defer until age 70. So here you see, this is our general advice here. When to take it exactly depends on your circumstances. You may take it as early as age 62. Of course, if you've got different health histories, then shorter health histories, I mean by that, then you might consider taking it earlier. Couple with similar incomes might consider delaying their claim. There used to be some pretty fancy strategies called file and suspend, where you could take your spouse's, you could take a spousal benefit on your spouse's worker benefit, but they got rid of that in 2016. So now, really, the strategies are far fewer these days. But John, maybe you can tell us a little bit about the Australian age pension and what we need to know there.
Yeah, thanks, Ashley. So I guess there's a few qualification criteria that you need to meet for the Australian age pension. So the first one is a residency requirement. So you need to have typically lived in Australia or been a resident of Australia for 10 years in total, and at least 5 of those years need to have been without a break of your residency. Now, for those that may not meet that criteria, there is a double or a social security agreement between Australia and the US that may mean that the periods of coverage can count towards that 10 years. Yeah, there are a few things to meet as part of that. Once you've met that residency qualification, there's an age qualification. So that is slowly increasing to age 67 to qualify for the age pension in Australia. At the moment, I think is a little bit less, but it will be 67 very soon. Once you've met the age qualification for the age pension, it is then a means tested system. So looking at your income and assets. So essentially what happens is that your income and assets will be assessed under 2 different tests. Whichever one you're worse off on will be the applicable test. Unlike the US system, it is not for everyone. It is for those that do need it. And potentially, I mean, similar to Ashley, whenever we're projecting out for clients, especially 10, 15 years in advance, we tend to exclude the age pension because we've got aging populations, we've got people living longer. The pressure to change what who will qualify for the age pension will increase. So, but at the moment, for a single homeowner, if you've got under $578,000 in assets outside of the family home, you will qualify for a part pension. For a couple, so you are assessed as a couple outside of the family home, if you have less than 869,000, you qualify for at least a part pension. So they're the considerations there. But your income, if you are earning some income and your financial assets do come into that under the income test as well. So moving on to estate planning. So there are some things to be mindful of on the estate planning side, on the Australian tax side of things. So firstly, looking at superannuation, and the first thing I want to note is that with superannuation, under Australian superannuation law, is a non-estate asset. So it's not actually covered through your will, superannuation. What you need to do is actually have a binding nomination on your superannuation, a binding nomination which would dictate what actually happens to your super balance upon your passing. Now, the potential taxes on your superannuation balance are dependent on who will be your beneficiaries. And this is on the Australian tax side of things. So if your spouse, you're a child under 18 or a financial dependent are your beneficiaries, they won't pay tax on your superannuation benefits. If your beneficiaries are a child over the age of 18, someone that's not a financial dependent or a friend or someone that isn't your spouse or one of the categories I mentioned earlier, there is the potential to pay up to 17% tax on the balance of the fund upon your passing. Now, what the end tax amount will be depends on how that money entered the superannuation system, but that's just something to bear in mind, and potentially get some get some advice around if a non-tax dependent, as they call it, so a child over the age of 18 or a friend or non-tax dependent is your beneficiary. Typically with your primary residence for Australian tax law, if you sell it within, or if your beneficiaries, I should say, sell it within 2 years of your passing, there won't be capital gains tax on the sale of your primary residence. However, there can be some taxes capital gains taxes if they sell it beyond that. So that's something to get some advice around. One thing I wanted to briefly touch on, and again, we could run a full seminar on this. It is a really complex area of US tax law, but is the US citizen potential estate taxes that you may pay on your worldwide assets. So there is a cap on any potential estate taxes that you pay on your rental estate, which I think is around 11.58 billion at the moment of US dollars on your eventual estate. However, any gifts in your lifetime can diminish that lifetime cap or that cap on your eventual estate, and the gifts to a US citizen spouse won't count towards it, but to a non-US citizen spouse, if you go over a certain limit, they can count towards it. Gifts to children can potentially count towards it. So potentially some planning is needed there if you are looking to gift, but again, get some advice around that if you're looking to do that. But it is a really complex area, but I just wanted to raise that as a consideration.
Awesome. Hey, thank you for your comments, John. That's fantastic. That really wraps it up for tonight. So thank you everyone for attending. If you want to get a hold of you, John, how would someone do that?
So yeah, absolutely. You can send me an email. So my email is johnv@aptwealth.com.au, or email Ashley, and he'll be able to pass my email along if you'd like to have a chat. We do offer a free chat for anyone that's interested.
All right. Well, let me. Why don't we just take a second, John, if you've got time,
Really?
a few minutes of questions, and we'll see if we can be of assistance here.
Absolutely.
All right. So I'm looking at the Q&A panel. I'm not sure if you can see that. You can.
Yeah, thank you.
So let's divide and conquer here. So Sandy Roberts, if planning to move from Australia to the US, is there some planning to increase cost base prior to leaving, utilizing the resident primary residence exemption?
So is that in relation? I assume that's in relation to Australian.
Yeah, sounds like it. Yeah, real estate. Right.
Yeah, so with the changes, unfortunately, that are proposed and are likely to, well, not proposed, that are legislated into law and are coming into effect, I'm not aware of anything that can potentially increase your basis. However, as a resident of Australia, you will get a much better tax treatment if you were to sell your property as a resident of Australia, your Australian primary residence, I should say.
Okay. Next, from Marion Solomon. Thank you for joining us, Marion. Is there a difference if you sell your home as a non-resident or Australian resident as far as CGT? Will it be taxed 50% of the CGT either way? This is in your court, John.
Yeah, so there is a very big difference. So I guess the big thing is, so the primary residence, as we mentioned, yes, there is a big difference that selling it as a non-resident and selling your primary residence overseas can potentially trigger a lot more tax than if you were to sell it whilst you're an Australian tax resident. For an investment property, whilst you're a non-resident for Australia, so the way it typically works as a resident of Australia is that investment or any investment, you get a 50% discount on your capital gains if you've owned the investment over 12 months. Now, as a non-resident, that's not available to you, and for the period that you're a non-resident, and that's for Australian property, whether you sell it whilst you're a non-resident or when you come back, for the period that you're non-resident, that will still apply. And that's a very important thing to think about is any investment asset is to think about what your after-tax earnings will be. So for your primary residence, so for investment property, you'll pay the full CGT and you're guaranteed to pay between 32.5% and 45% on an investment property whilst you're a non-resident. Assets like shares is actually treated very, very differently. That you, as you're a non-resident of Australia, you're likely to pay actually no capital gains tax on your Australian capital gains on the shares whilst you're a non-resident. You'll be seen to have actually purchased the asset from Australian tax law on the day you return and become a tax resident of Australia. So that's a really important point to bear in mind, and can really change the after-tax return that you do get. Hopefully that answers your question, Marion.
Just jumping down a little bit here. So, Mr. Robert Bressy, how are US investments treated by the IRS and ATO for Aussie expats who've returned to Australia? Would you have to continue to submit a US tax return and pay tax on worldwide income as long as you have US investments, even if you aren't a US tax resident? Robert, no. Short answer is no. I know in your circumstances you will file a partial year tax return for the US and for California. And also, as you no longer have any US residency, then what you're earning in the US is not considered US sourced property. That's the key term, the key concept here is the source of that income. It's not considered US sourced, it's Australian sourced. So even though those investment accounts are domiciled in the US, you don't owe US tax on it because you're not a US citizen. Nick here, why does conventional advice say we need to choose between the US and Australia for residents? We plan to maintain a house in both countries and travel back and forth. If I might have first dib at that one, it's not so much conventional advice as law. And it's actually what I'm writing a blog post about right now. It's to do with the three different definitions, Nick, of residence. There's your legal residence, there's your tax residence, and there's your estate, essentially your estate residence, your domicile, where you intend to live long term. And so there are quite strict rules that will determine and will guide a dispute in if there is one between which country has primary taxing rights over your income in a given year. You will either be primarily a tax resident of one country or the other. In the US, it's what is it, the 183-day rule. And then they also count the years going back 3 to 1. It's some percentage of the days the year before, a smaller percentage the year before that, et cetera, et cetera. So it's not so much conventional wisdom as it's just tax law.
Yeah, yeah. Very good point. And yeah, to your point, Nick, I mean, I've got a lot of clients that do aim for your goals there, living part of the time in the US and part of the time in Australia. No one is saying that you can't do that, and absolutely we encourage that as financial planners. But it's more looking at, I think, what the conventional advice is tax residency rather than actual, where you're going to physically be. And there are some planning considerations there about how long you spend, and a few days either way can potentially make a bit of a tax impact there and a tax benefit for you. So, but you certainly can achieve that goal that you're looking for to spend part of your time in both countries.
Werner's question here, as an Aussie in the US, what is the most cost tax effective way to transfer money to the US to buy a house here? Well, I think I covered that in foreign exchange. That's really where that is. And my answer would be Interactive Brokers, although we're not recommending any particular product here. I'm just stating that's what I'm aware of as the lowest spread. Is that money taxed in the US? Money that's transferred? It could be. In theory, it could be. If there was a foreign exchange movement, if you realized some major gain on your currency holdings from one year to the next, but that's another topic for another time. Malcolm Booth, thank you also for joining us here on the presentation tonight. So what I spoke about was the HEART Act, H-E-A-R-T of 2008. It determines whether you are deemed a covered expatriate. I did a webinar on that. I believe that was late last year where I went through that. Interesting topic. This recording will be made available. I'm going to post it up on YouTube and let everyone know when that's up. Typically takes us a couple days, but give us till the end of the week and we'll have that up. Maybe John, you want to have a stab at this one? Matthew Thomas, on the chat window if you can see that.
Yeah. So I can see that for for anyone that can't see it, for two Americans living in Sydney in the late 30s, what are the 1 2 best things we should be trying to do to increase our overall wealth? So I guess as Ashley mentioned it a little bit earlier on, I think you obviously want to allocate a certain portion towards your living needs now. You're in your late 30s, you want to enjoy life now, but also allocating a certain amount towards future investments as well. And you need to be very, very mindful of, again, the after-tax treatment of your investments being US citizens in Australia. As Ashley mentioned, the PFIC side of things, so the passive foreign investment companies, if you're thinking of exchange traded funds or managed funds or any non-direct investments in Australia, just be a little bit careful because there will be some potential extra taxes in the US, on the US side of things, and some potential extra reporting requirements on your US return, which will diminish your overall wealth. But also looking at potentially putting some funds away towards retirement, but just looking at looking at the tax treatment of those contributions and potentially into the Australian super system and how that will treat. So as a general rule, not going over what your employer puts in is a good rule to follow, but it does vary between accountants, as I'm sure you've probably seen, Ashley.
There's a spectrum you can shop for your opinion, it seems. Although hopefully with the conclusion of this Dixon case coming, that will provide a little bit more clarity on some of the more avant-garde strategies that have been out there.
It'd be amazing to just get some clarity, even if it isn't the answer we want to hear. At least we know with absolute certainty. But at the moment, I think what Ashley, I'm sure, does, and what I do is we collaborate with a US accountant and make sure that you don't, so always speaking with a US accountant with any super strategy is really important.
Yep. I'm actually at time, John. There's a couple more questions. Paula at Jane Hamilton, I just want to say, to be honest with you, that question, at least as far as I read it, that is actually supremely complicated. It's not something we could answer, just on this call. I don't know how you feel, John, but that's a curly one.
Yeah, it's probably some things that we would need to know a little bit more about, Paula. Definitely appreciate your question, but send it through to Ashley or myself, and we potentially could bring in a tax specialist to work through some of those issues that you're facing.
Absolutely. Hey, thank you so much for joining me here, John. It's been fantastic. Wonderful to see such a great turnout, and I hope you can all join us next month as we talk about real estate.
Thanks for having me, Ashley.
Thank you so much. Catch you later. Bye-bye.